Hi, I'm Matt Rees, and this is episode 15 of 3 Minute Tech. These are the videos where we cover your strategic financial planning questions without all of that technical jargon, using simple, easy to understand language. So today, we'll be focusing on our part B of succession planning. We're talking about what are some of the additional considerations for farmers and family businesses. In addition, what are some of the tax relief or the tax concessions available as well? So are there additional considerations for family businesses and family farms? Well, unfortunately, there is, and it is more complicated. Because when we're dealing with family, we often want to make it equal between the children. Now, particularly with farmers here, we're dealing with large, lumpy assets, and this is difficult to actually attain. So what do we do? Well, it's important to start talking about off-farm investment. How is this achieved? Is it feasible? Potentially down the line, if one of the children is going to inherit the farm, can this be done through a purchase agreement which provides that residual capital for the remaining kids? There are options available, but we need to talk and plan early. So when we're talking about succession planning, are there any tax considerations here or tax relief? Well, there is, and the one we're focusing on today is the small business capital gains tax concessions. Now, this allows eligible small businesses to reduce or even eliminate the capital gains from a sale or succession plan. The four main concessions are a rollover relief, deferring that capital gain. There's also the 50% capital gains tax concession, so eliminating 50% of the gain. There's the retirement exemption, allowing you to disregard over $500,000 of capital gains. And the last but not least is the 15-year exemption, allowing you to disregard the whole capital gain and move more money into superannuation. So in today's case study, we have Roger and Samantha. They're 64 and 60, and they're really successful farmers. Now, they have two daughters which have made it very clear they have no interest whatsoever in operating the farm, and neither do their husbands. So they want to spend a bit more time with their grandkids and less time farming. So they've been discussing their succession plans and make the tough decision to sell their farm. Now, their farm is valued at $10 million. They actually purchased it 32 years ago for $2 million. So it's been a fantastic investment in their own right. Now, what can they do here? Well, through the small business capital gains tax concessions, they can actually disregard the whole capital gain. So that's $8 million that they pay no capital gains tax on whatsoever. That's a fantastic result. On top of that, they can actually move $3.2 million into superannuation outside of their contribution caps, which again is a great result, particularly given that they can commence a tax-free income stream going forward. So all in all, saving tax now and into the future. So what have we learnt today? Well, we know for farmers dealing with large, lumpy assets, it can be difficult to provide equalisation across their children. And therefore, it's important to consider their succession plan early and enable you, family, and key stakeholders to plan for that. Now, if they decide to sell the farm, there are some tax relief available. Now, this tax relief can be significant. It can eliminate the capital gains tax, it can reduce the capital gains tax, and it can enable you to move more money into superannuation. And you know, we've discussed that in the past, superannuation is a fantastic investment structure.